Why you should not trade non-farm payroll. Okay, so welcome to these new episodes for the video series Professional versus the Retail, where in this video series I'm going to show you what is the different approach taken by the professionals that actually make the professionals trader in the hedge funds and the investment bank billions of dollars. Okay, now if you have been in the trading world for quite some time, right, you will probably heard a so-called fundamental trading strategy called trading the news or trading the economic data release, right? What this strategy basically does is that they tell you that, okay, you should look for the economic calendar, right, and pinpoint some of the most highly impact economic release, right? For example, the non-farm payroll in the US, right, or the interest rate decisions released by the central banks of all of the major currencies, right? They will ask you to focus on these types of economic data, right? They will ask you to trade the release, right? Basically is that when the data comes out better than expectations, what you need to do is that you long the currency, right? If the data comes out and is worse than expectations, you should short the currency, right? Now, professional traders, we do not do that, right? We do not trade the economic data releases. In fact, we predict the economic data months before the release actually occur, right? Because here's the thing, right? If you have some basic understanding in the economy, right, or you have been through some education on macroeconomics, right, you will know that all of these high impact data are usually coincidence indicator, right? There are things like inflation rates, the NFP is basically the employment data, right? And also the interest rates, right? Now these things, they are really coincidence indicator, right? They are basically telling you what is happening in the economy right now, right? And indicator like this can be predicted using leading indicators, right? So as a professional traders, we have been looking at these leading indicators months ago, right, predicting what is a possible future outcome, right? What is the possible future outcome? And then we position ourselves to catch the trend, right, to catch the volatility before the actual release, right? So it means that we already know, we already predicted what is the number that is going to come out on the NFP, right? What is the number that's going to come out on the inflation rate? What is the number that's going to come out on the interest rate decisions, right? And then we basically position ourselves to take advantage of this, right? And when the economic data releases, right, when the retail guy, when the dumb money rush into the market to trade the news or to trade this economic data release, professional traders, we are using your liquidity, to be honest, we are using your liquidity to get out of the positions. And at the same time, we are now looking at the latest leading indicator, right, so that we can we can position ourselves once again, right, to take advantage of the future release. Okay, so we basically already predicted what the result will be, right? And retail guy, you have been taught, by all of these guy, all of these YouTuber, all of these influencer, right, that trading economic data upon release is a fundamental analysis trading, right? Well, which is not, right? Because anything that is going to come out on the data is really predicted, right? Because, right, so if you're really going to generate your trade idea based on fundamental analysis, you should really focus on the leading indicator, right? Not the coincidence indicator, right? Because if you know what the leading indicator is telling you, you can predict the results of the coincidence indicator, right? And then you can take advantage of this. Okay, so you should really focus, if you're really into the fundamental analysis trading idea generations, right, which I encourage you to do so, right, because this is how hedge funds traders and investment bank prop traders, right, this is how we generate our trade ideas. Okay, so I really encourage you to stick to the fundamental analysis for idea generation. Okay, and what they're telling you is that you should trade based on the expectations, right? So if the number comes out better than expected, you should long that currency, and if the number comes out worse than expected, maybe you should short the currency, right? This is true in some cases, in a very, very short term environment, right? Because if you have some basic understanding on the economics, you will know that the value or the exchange rates of the currencies is really not depending on one or two coincidence indicator, right? It's really not depending on either the interest rate, or is not depending on either the inflation rate, right, or the employment rate, right? The exchange rate for that particular currency is affected by a bunch of indicators, right? So if you just look for 1 to 3 indicators, right, and you trade with that thing, right, you trade just with the expectation number, is really not fundamental analysis, because you don't really understand what is the difference, what is going on behind the exchange rates, right? Because it will influence by, first, the local indicators, right? Let's say you're trading the US dollar, right? The US dollar is going to affected by the local indicators, right, which is the economic data in the US, and also the economic data outside the US, right? So if you think that simply by trading economic data is fundamental analysis, well, unfortunately, you are wrong. Right, you are wrong. This is not, and it's okay, everyone make mistakes, right? Remember that you should not trade the economic releases, right? In fact, what you should do is really focus on the leading indicators, right? Because the leading indicators is going to tell you what is the future data, what is the future readings for the coincidence indicator, right? And this coincidence indicator is going to affect how the central banks, how the governments, right, how the central authorities, right, react, right, or react to their monetary policies, right? The coincidence indicators is going to make the central bank either to tightening or loosening the monetary policy, right? So If you can understand the leading indicator, right, then you can predict the coincidence indicator, and at the same time you can predict what the central authorities, what the central bank will do, right, and you can make a profit with this information, right? So this is one of the approach that we use, right? And another big mistake is that a retail trader will think that the combination of trading the economic data with some basic computation methods, right? Maybe calculating the P&L, right? Or maybe calculating the average returns, right? And the technical analysis, right? The combination of the technical analysis, the economic data, and some basic computation. They think that this combination is fundamental analysis, which is not, right? Fundamental analysis is a much more broader, right? Much more big, a much more broader concept, right? Or a much more broader topics, right? Rather than just some economic data, right? So remember, do not trade economic data upon release, right? What you should do is that you predict the economic data, right? So you are becoming the smart money, right? You are predicting what will happen in the coincidence data, which is all kind of inflation rates, all kind of employment rates, right? You are predicting this data, right? Months, right? Few months in advance, right? So you have positions yourself, right, a few months in advance, and once the data releases, you use the liquidity provided by the dumb money, right? Liquidity provided by the retail guy, and you close your positions and make profits. Okay, so never trade economic data. Professional traders, we do not trade economic data, right? Any professional traders will tell you that they will trade economic data. They are not trained, or they have not been working in the financial industry, right? They have not trained by hedge funds or investment bank prop desks. Okay, because if they have been trained under those institutions, they will know that economic data is not for trading. Economic data is used to predict, right? So as usual, remember to subscribe and hit the bell. I'm going to see you on the next video.